America didn't abandon real money in 1971. That shift had already begun more than a century earlier, and almost no one noticed. In the early 1850s, something strange started happening across the United States. Silver coins began disappearing, dimes, quarters, half dollars. They were quietly vanishing from circulation. Shopkeepers noticed. Banks complained. Ordinary Americans began holding on to whatever coins they could find. At first, it looked like a simple shortage, but it wasn't a shortage, and it was a signal that something inside the monetary system had started to break. And the cause wasn't obvious. It wasn't a war. It wasn't a financial crisis, and it wasn't a decision made in Washington overnight. It was the result of a deeper structural problem, one that had been building beneath the surface for years. Because at the time, the United States wasn't using one form of money, it was using two. For much of the 19th century, the United States operated under something called a bimetallic monetary system. Both gold and silver were legally defined as money. The government set a fixed exchange ratio between the two metals. In the United States, that official ratio was 16 ounces of silver equal to 1 ounce of gold. In theory, this meant gold and silver coins could circulate side by side as stable forms of money. But the system contained a hidden weakness. Governments could declare the ratio between gold and silver, but they could not control the global supply of those metals. And when the supply of other metal changed, the market value between the two metals changed with it. The official ratio stayed fixed, but the real ratio in the global market moved. And when that happened, something predictable occurred. When two forms of money circulate together, people spend the money that is less valuable and keep the money that is more valuable. Economists later summarized this principle in a simple phrase known as Gresham's law. Bad money drives out good money. If one type of coin contains more intrinsic value than another, people tend to hoard it, melt it down, or export it. Meanwhile, the less valuable currency continues circulating. By the early 1850s, that is exactly what began happening in the United States. And the cause was not domestic policy, it was a global event. In 1848, gold was discovered in California. Just a few years later, massive gold deposits were discovered in Australia. These discoveries flooded the world with new gold. The supply of gold expanded dramatically in a very short period of time, and as the supply of gold increased, its relative value began to fall compared to silver. But the United States was still using the fixed 16-to-1 ratio between the two metals, which meant something strange had suddenly happened. Silver was now worth more on global markets than the US government said it was worth. In practical terms, the silver inside American coins had become more valuable than the coin's face value. A silver coin might say 25 cents, but the metal inside it might be worth 27 cents or 30 cents if melted down. And when that happens, coins stop circulating. People hoard them, export them, or melt them down for their metal. The result was exactly what Americans began noticing in the early 1850s. Silver coins disappeared. The monetary system had encountered a structural problem, and Congress needed to respond. In 1853, lawmakers passed what became known as the Coinage Act of 1853. The solution they chose was simple: reduce the silver content of smaller coins. Dimes, quarters, and half dollars would now contain less silver than before. By lowering the amount of precious metal inside the coins, the government ensured that the metal value of the coin would always remain below the face value stamped on it. In other words, the silver inside a quarter would never again be worth more than 25 cents. This solved the immediate problem. Coins could circulate again without being melted down. But something deeper had changed. Before this moment, most American coins were essentially pieces of precious metal stamped by the government. Their value came directly from the metal they contained. But after 1853, many coins became something different. They became token money. coins whose value came less from the metal inside them and more from the authority of the government issuing them. At the time, this seemed like a small technical adjustment, but in reality, it represented a subtle shift in the nature of money itself, and it opened the door to a much larger transformation. Over the following decades, the American monetary system continued evolving. Silver was eventually removed from the official monetary standard. Gold became dominant. Modern banking institutions expanded. The Federal Reserve was created to manage the nation's currency and credit system. And finally, in 1971, the United States ended the last formal link between the dollar and gold. By the time that decision was made, the shift away from metal money had already been unfolding for more than a century. The disappearance of silver coins in the 1850s was one of the earliest signals that something fundamental was changing. But the events of that decade also revealed a deeper limitation of metallic monetary systems. When the supply of money depends on the mining of precious metals, the economy becomes tied to geology. New discoveries can suddenly flood the system with currency, but shortages of metal can have the opposite effect. And when the supply of money fails to grow alongside economic activity, something important happens. There simply isn't enough currency to support expanding trade and production. Transactions slow down, credit becomes scarce, investment declines, and economic growth begins to stall. In other words, when money becomes scarce, economic activity itself becomes constrained. This was not a new challenge in world history. Centuries before the United States existed, Chinese governments had already struggled with the limitations of metallic money. During the Song and later Yuan dynasties, China experimented with some of the earliest large-scale paper currency systems in history. At first, these systems worked remarkably well. Paper money allowed governments to expand the supply of currency beyond the limits of mined metal, supporting trade across one of the largest economies in the world. But many of those early experiments were eventually mismanaged. Governments printed more currency than the economy could support. Inflation followed, and trust in paper money collapsed. The experience left a deep imprint on Chinese economic culture. For centuries afterward, large parts of the Chinese economy relied heavily on silver as the primary store of value and medium of exchange. Paper currency was widely distrusted, but tying the monetary system closely to silver created its own constraints. When the supply of silver failed to expand alongside economic activity, the supply of money tightened. Credit became limited. Economic expansion slowed. And in some periods, this contributed to long stretches of stagnation. Meanwhile, Western economies were gradually experimenting with more flexible financial systems, expanding credit markets, developing modern banking institutions, and eventually moving toward centrally managed currencies. These systems allowed governments and financial institutions to mobilize capital on a much larger scale. By the 19th century, that flexibility helped fuel the rapid expansion of industrial capitalism, giving Western powers the ability to force open markets, dominate trade, and reshape entire economic systems in their favor. The history of money reveals a constant tension. Systems tied too tightly to precious metals can struggle to supply enough currency for growing economies. But systems based purely on paper must still maintain trust and discipline to avoid inflation and instability. Every monetary system must balance these competing pressures. Today, we may once again be living through another period of monetary transition. Global debt levels have reached historic highs. Governments and central banks are experimenting with new policies and financial tools. At the same time, alternative monetary systems are gaining attention. Gold continues to attract interest as a store of value. And digital systems like Bitcoin are emerging as attempts to solve some of the same questions societies have struggled with for centuries. How do you create money that is scarce enough to maintain trust, yet flexible enough to support a growing economy. The disappearance of silver coins in the 1850s may seem like a small historical curiosity, but it revealed a deeper truth about money itself. Monetary systems evolve under pressure, sometimes slowly, sometimes suddenly, and sometimes the first sign of change is something very small, like a coin quietly disappearing from circulation.